Hello, and welcome back to Reflections on Investing with the Cornell Capital Group. And today we have a bit more extensive reflections. We're going to focus on a number that I think is the most important in investment analysis, the equity risk premium. But it's elusive. This is a number that I began to be interested in when I was a young professor at UCLA, and one of my students, Aswath Damodaran, also found it to be of interest. So as time passed in the 90s, I ended up writing a book on the equity risk premium. And then later, Professor Damodaran, who is now at NYU, picked it up and has produced annual articles that are almost book length on the equity risk premium. But even more importantly, each month he estimates the implied equity risk premium. I'll explain what that is in a minute, because we at the Cornell Capital Group do basically exactly the same thing. So what I'd like to take you through is how the implied equity risk premium is estimated, both by Professor Damodaran and the Cornell Capital Group. And I'll do that by starting with Professor Damodaran's spreadsheet, which every month he publishes along with his estimate of the equity risk premium, and then simplify that to its raw elements. And in that way, I think you'll be able to understand what's going on here. But before we get started, one more point. What is the implied equity risk premium? It's the following. We know the level of the market index. We have forecasts of future earnings provided by analysts on the market. And from those, we can ask what discount rate is required to discount the forecasts of future cash flows back to the value of the index. That sounds like a mouthful, but what it really means is what equity risk premium must be existent in the market so that the fundamental value of future cash flows equals the current market level. And I hope this will all become much more clear when we use an example. But before we get started, one more word of warning. If you're not familiar with financial concepts, some of this may sound a little Greek. But bear with me, because even if you don't understand the math details, the implications are so important, I think you'll want to stick with me to the end of this video. So let's go to the computer and get started. The first input that we use here is the current level of the index. And this calculation was done both by Professor Damodaran and by Cornell Capital Group on October 1st, 2024. So all data is from that point. And the close of the S&P 500 on that day was 5762.48. As a measure of the risk-free rate, Professor Damodaran and us use the 10-year Treasury rate, perhaps the most followed interest rate in the world. And on October 1st, the 10-year Treasury rate was 3.81%. And that's our estimate of the long-term risk-free rate. The next number is the equity risk premium. And don't take this 5% as an answer. That's a plug. I just put it in. You'll see how this works as we go forward. But what the equity risk premium is the amount of added expected return that investors require to hold common stock, given that they could get 3.81% in the risk-free asset. In other words, how much more do they require in expected return to hold stocks along with bonds? And that's going to depend on two things, both their perceptions of risk and how risk-averse they are. And both those can change. There'll be periods of time when investors are very fearful and very risk-averse, and they think that risk is high. The great financial crisis could be an example. Now, in order to complete this analysis, we also need an estimate of the long-term growth rate for earnings in the economy. And we're going to use the 10-year Treasury rate because that reflects both real growth and expected inflation. Okay, that's part one. Now, in order to compute the cash flows that get discounted to estimate fundamental value, we need estimates of future earnings. And analysts provide those estimates, and there's a so-called Analyst Consensus. That's what Professor Damodaran is going to use, and we're going to follow him in that regard. And here's how it works. The actual earnings on the S&P 500 in 2023 were 221.36, as shown on the screen. What we need are forecasts of the future earnings. And what Professor Damodaran and CCG do is turn to consensus analyst forecasts. And we will follow Professor Damodaran in this respect so that we can put his numbers. Based on the analyst forecast, he concludes that the average growth rate in earnings over the next 5 years will be 8.48%. And that's quite optimistic. The economy is expected to grow at about 4 to 4.5%. So earnings would be growing faster than that, meaning that earnings would become a bigger piece of the GDP pie. But earnings are already about as big a piece of the pie as they've ever been. So one has to worry that political forces will come into play to prevent corporate earnings from growing that rapidly. But that's what the analyst forecast is, consensus, so we'll use it. Finally, what you have to discount when you do a fundamental analysis is not earnings, but cash flow, the actual cash that investors take out of the investment, not the earnings of the companies. And this number, 77.92%, is Professor Damodaran's estimate of the cash flows as a fraction of earnings. And those cash flows would be dividends plus buybacks. So we're going to adopt that. So now if we go down to the second part of the spreadsheet, you'll see the dates across the top. This is last year, 2024, 2025, and so forth. Here's last year's earnings, 221.36, as I've already mentioned. And then each future year is increased by 8.48%, the growth rate down here. So it's 240, 260, 282, 306, and 332 in the fifth year. But earnings don't stop in year 5. They go on indefinitely. So we need an estimate of what's called the terminal value of the earnings. And Professor Damodaran and CCG use a so-called constant growth model to do that. That is to assume that after year 5, earnings grow at the same rate as the economy indefinitely, and that rate is the long-term growth rate of 3.81%. And that allows us to compute the so-called terminal value in the fifth year of those continuing cash flows. And that's this number 5379482. Okay, so those are the future, I skipped a step here. That gave us the earnings, but we don't discount the earnings. We discount the cash flows. So the earnings have to be multiplied by the 77.92%. And that gives the future expected cash flows. 187, 202, 220, 230, 238, 259, and the terminal value. Now, those future cash flows have to be discounted back to present value to get an estimate of the fundamental value. And what's the discount rate? It's the risk-free rate of 3.81 plus the required risk premium. That's 8.81, and that's shown here as the required return on stocks. Investors require a return equal to the risk-free rate plus the risk premium. So there's the discount rate every period, 8.81. Now, when you take that 8.81, you can discount the future cash flows back to present value. That's a finance technique. If you're not familiar with it, trust me, it's probably worth picking up a finance book to look at because it's such a widely used approach. But for now, I'll just treat it as known. So the 2024 cash flow, we only have 3 months left, or a quarter of the year. So there's only 0.25 of a year left, and we only get 0.25 of the 2024 cash flow. That allows for a present value of $45.80. In 2025, we get the whole cash flow. It's discounted back a year and a quarter to get to the present, all of 2025 plus the 3 months of 2024. And we proceed in that fashion and discount all the future cash flows. We then add up all those discounted future cash flows to get an estimate of the fundamental value of the S&P 500, which here works out to be 45.3082. But that's just based on the plug that I had in there of 5%. So the last thing that Professor Damodaran and I do is we use the solver involved with Excel to solve for the equity risk premium that leads to the fundamental value equaling the current price. So let's do that. Go up here to data, bring up the solver. Here's the solver. Let me move it over here so we can see everything. I want to discount cell C23. I want to set the objective cell C23, the fundamental value, equal to 57.6248, the current index, by changing the equity risk premium. So let's do that. Solve. And okay, let's keep it. Turns out the answer is 3.94%. So if investors only require 3.94% above the 10-year risk-free rate to hold stocks, the fundamental value of the S&P 500 would be 57.6248, which it was on October 1st. And this is the number that Professor Damodaran reports in his blog and other things where he says what the implied equity risk premium is. And we agree. Now, what happens if investors change their mind? What happens if they're not willing to accept 3.94%? If they require a bigger premium for holding stocks? For instance, Professor Damodaran has calculated this equity risk premium every month since January 2008. And the average equity risk premium over that time is 5.42%. So what happens if investors say, I need that 5.42%. I'm not satisfied with 3.94. There's too much risk. Well, if we put in 5.42, the fundamental value of the market drops to 41.75, 28% down. And just recently as 2021, when things seemed to be riskier, the equity risk premium was 6.21%. Investors said, geez, these are some risky times. I'm scared. I want 6.21. If I put 6.21 in here, the fundamental value drops 36, 38, 37% down from the current level. Now, one more thing. Earlier, I said that this 8.48 was optimistic. It had earnings growing much faster than the economy. Suppose I put in, instead of 8.48, 4.5, the growth rate of the economy. Now, the estimate of the market index is down to 30.58, almost 50% below its current value, which is a number that people like Jeremy Grantham and Professor Hussman have been talking about. I think you can take from this two things. One, the immense importance of the equity risk premium in determining the fundamental value of the index. And two, the risk on the downside if investors begin to require a higher equity risk premium because they perceive more risk or become risk averse. That is why, if we leave the computer now, that is why at the Cornell Capital Group, we're quite concerned. We see the potential for drops of the magnitude that I've just shown on the spreadsheet should investors return to more average risk aversion and risk assessment, leading to an increase in the equity risk premium to something like 5.42%. So feel free to contact the Cornell Capital Group if you'd like to get this highly simplified version of the implied equity risk premium calculator and play with it yourself, because I think there's nothing more important to understand. This has been Reflections on Investing with the Cornell Capital Group. Thanks for joining us.